activities relating to operating, investing as well as financial activities are recorded in Accounting Standard 3. This Accounting Standard 7 is being used relating to the construction contracts. Any fluctuations that are taking place in the foreign currency or foreign exchange, so that will be included in the Accounting Standard 11. Whatever the transactions relating to borrowing cost, that will be recorded in the Accounting Standard 16 in the financial statement. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. My dear students, today we are in the last session, that is 9th session of Unit 1 of the subject Fundamentals of Business Accounting, and this is for first sem B.B.A students. And the Unit 1 is all about Introduction to Financial Accounting. So, we have already discussed few of the concepts. So, let us quickly recall what we have discussed in a previous session. So, in the previous session, I have covered this topic, that is, we have learnt about accounting conventions and we have learnt about difference between accounting concepts as well as conventions. A very important topic that we have discussed is accounting concepts and accounting conventions. Next, we have learnt about what is this accounting standard, need for accounting standard, benefits as well as limitations of accounting standard, and where this accounting standard is being applied, that is applicability of accounting standard. So, these are the few concepts what I have already discussed in a previous session. In today's session, we shall continue with list of, that is, mandatory accounting standards. So, here today I am going to discuss few of the accounting standards which are very mandatory in the accounting. So, let us discuss about it. Here is a summary of accounting standards issued by ICAI. So, in the last session itself I have told you this accounting standard is being issued by ICAI, that is Institute of Chartered Accountant of India, as well as Companies Rules. So, it is being issued by ICAI and Companies Rules 2006, notified by the Ministry of Corporate Affairs and Government of India. So, here what you have to remember here, this accounting standard is been issued by ICAI, that is Institute of Chartered Accountant of India, and Companies Rules 2006, and it has been notified by the Ministry of Corporate Affairs, Government of India. These standards are followed by the auditors of financial statements along with the stakeholder. So, whenever an accountant prepares his financial statement, he has to follow all these accounting standards. At the same time, while auditing also, the auditors will follow, and it is being followed by the stakeholders also. Now, we shall see what are the accounting standards. So, individually we shall discuss few of the accounting standards today. So, the first is policies relating to the accounting disclosure, that is Accounting Standard 1. So, this Accounting Standard 1 tells about policies relating to the accounting disclosure. So, this standard deals with the disclosure of significant accounting policies. So, it tells about what are the important accounting policies or policies to be followed in accounting, which are followed in the preparing as well as presenting the financial statement. So, what are the important accounting policies that has to be followed while presenting this financial statement? So, that we learn under Accounting Standard 1, that is relating to policies related to accounting disclosure. Now, coming to the next accounting standard, that is Accounting Standard 2. We are going to learn about valuation of inventories. So, how the inventories has to be valued, how the stock in an organization has to be valued. So, that will be included in the Accounting Standard 2. So, let us see what is it. This standard deals with the determination of value at which the inventories are carried in the financial statement. So, how we are going to treat the inventories in the financial statement, or how we are going to consider the inventories in the financial statement. So, that we are going to learn under Accounting Standard 2, including the ascertainment of cost of inventories and any written down or write down thereof to the net realizable value. So, how the inventories or the stock has to be realized or how it has to be treated in the financial statement, that is Accounting Standard 2. Now coming to Accounting Standard 3, we are going to learn about the cash flow statement. So these are the cash inflow as well as cash outflow, where we are going to record in a particular statement, that is cash flow statement. So this Accounting Standard 3 tells about cash flow statement. So this standard deals with the historical changes in the cash. So it's all relating to the cash and cash equivalent of an enterprise. So here the cash flow name itself says that it is relating to the cash as well as cash equivalents. This is done by preparing a statement popularly called as what? Cash flow statement. I have told you, in cash flow statement, we are going to record cash inflow as well as cash outflow. So for that, we are going to prepare a statement which is known as cash flow statement. This statement classifies the cash flows during the period from operating, investing as well as financing activity. So what type of transactions we are going to record? So we are going to record the activities relating to operating, investing as well as financial activities are recorded in Accounting Standard 3. Now coming to Accounting Standard 4. So here under Accounting Standard 4, we are going to learn about contingencies and events occurring after the balance sheet date. So what we are going to learn under Accounting Standard 4, that is this standard deals with the treatment of contingencies and events that has occurred after the balance sheet date. That is, after the preparation of balance sheet date, what are the contingencies or events that has been taken place? So how we are going to treat that? So that we are going to learn under Accounting Standard 4. Now coming to Accounting Standard 5, we are going to learn about net profit or loss for the period, prior period items and changes in the accounting policies. So combinedly we are learning three of the things here. So we are going to learn about the net profit or loss for the period, prior period items. So what are the prior period items and changes in the accounting policies? That is Accounting Standard 5. So this standard should be applied by an enterprise in presenting profit or loss from activities in the normal course of business, extraordinary items and prior period items. So we are going to learn about the profit or loss in that particular period and relating to the extraordinary items or the prior period items. This also includes the changes in the accounting estimates and changes in the accounting policies. So here we are going to learn further more information on accounting policies also. Next one is Accounting Standard 7. So it will not be in the same order. So it will be reverse, or some accounting standard might be skipped also. So here Accounting Standard 7. So it is relating to the construction contracts. So this Accounting Standard 7 is wholly related to the construction contracts. So this standards prescribe the accounting for construction contracts in the financial statement of contractors. So in the financial statement of the contractors, so this Accounting Standard 7 is being used relating to the construction contracts. Next is Accounting Standard 9. So it is related to the revenue recognition. So already we have learnt about revenue recognition concept, which tells that whenever the transaction have taken place, on that day we will record the transaction. It's not that when we actually receive and actually pay. That comes under Accounting Standard 9. So this standard deals with the recognition of revenue in profit and loss account of an enterprise. So where we find this revenue recognition, it is Accounting Standard 9 in the profit and loss account. Revenue recognition is concerned with revenue arising in the course of ordinary activities of an enterprise such as sale of goods, rendering of services, interest, royalties and dividends. So what we are going to receive, that is revenue recognition, from where we get the revenue. So that will be included in Accounting Standard 9. Next is Accounting Standard 10. So it's all related to the property, plant and equipment. So we call it as PPE. So the objective of this standard is to prescribe the accounting treatment for property, plant as well as equipment, that is PPE. Next is accounting standard 11. So it deals about the effect of changes in the foreign exchange rate. So whatever the changes that takes place in the foreign exchange rate, so that are included in the accounting standard 11. So accounting standard 11 lays down the principles of accounting for the foreign currency transactions and foreign operations. That is, any fluctuations that are taking place in the foreign currency or foreign exchange. So that will be included in the accounting standard 11. Next is accounting standard 12. It's all deal with the government grants. So this standard deals with the accounting for government grants. So there are number of activities like subsidies, cash incentives, duty drawbacks. So all these are included in the accounting standard 12. Next is accounting standard 13. So it is relating to accounting for investments. So whatever the investments that takes place, so that comes under accounting standard 13. So this standard deals with accounting for investments in the financial statement of enterprise and related disclosure requirements. So this financial investment, so whatever the investment that takes place in accounting, that comes under accounting standard 13. Next is accounting standard 14. So it's all relating to the amalgamation of the companies. So this standard deals with accounting for amalgamations and treatment of any resultant goodwill or reserves. So it's all related to the amalgamation and how we are going to treat the reserves as well as goodwill. Next is accounting standard 15. So it's related to the employee benefits. So what are the benefits that comes for the employee? So that will be included in accounting standard 15. The objective of this standard is to prescribe the accounting treatment and the disclosure of the employee benefits in the books of an employer, except for the employee share-based payments. So it is not related to employee share-based payment. Other than that, what are the benefits that are given to the employees? So that will be comes under accounting standard 15. So it does not deals with the accounting and reporting by the employee benefit plans. And also it does not include any of the employee benefit plans. Next is accounting standard 16. So it's related to the borrowing cost. So whatever the transactions relating to borrowing cost, that will be recorded in the accounting standard 16 in the financial statement. So this standard should be applied in accounting for borrowing cost. It does not deal with the actual or imputed cost of owner's equity. So here it's all relating to the borrowing cost. It does not include the amount of equity. Okay. So including preference share capital, not classified as a liability. So here it's not relating to the equity, it's all related to the borrowing cost. So which comes under accounting standard 16. Next is accounting standard 17. So it is reporting on financial segments. So the objective of this standard to establish the principle for reporting the financial information for different types of segments. How the financial information, so at the end of the preparation of the financial statement, so that financial information has to be communicated. So how it is being distributed to different segments or products or services and enterprise producers and the different geographical areas in which it operates. So it's all relating to the reporting on financial segments. Next is accounting standard 18. So it is related to disclosure of related party transactions. So it's all related to the party who is related to the transactions. So they are activities or their events will be recorded in the accounting standard 18. So this standard should be applied in reporting the related party transactions between the reporting enterprise. So between the reporting enterprise, whatever the transactions that takes place, that includes under accounting standard 18. The standard applies to the financial statements of each reporting enterprise and also the consolidated financial statement present by the holding company. So whatever the transactions which is being related to the holding company. So what are the consolidated transactions? So that all comes under accounting standard 18. Next is accounting standard 19. So it's relating to the accounting policies and disclosure on lease transactions. So here we have to note this. So it is related to the lease transactions. So the objective of this standard is to prescribe the appropriate accounting process that takes place in the lease transactions. So whenever leasing takes place, whatever the transactions that happens there, so they all comes under accounting standard 19. Next is accounting standard 20. So it is relating to per share earnings, or we call it as earning per share. So what is the earnings that we get on a particular share? So accounting standard 20 prescribes principles for the determination as well as presentation based on EPS, that is earnings per share, which will improve the comparison of the performance among different enterprise. So when we compare from one enterprise to another enterprise depends on the EPS. So easy comparison can happen based on accounting standard 20. So, among different enterprise for the same accounting period and different accounting periods for the same enterprise. So, here year after year comparison as well as with the comparison with the different enterprise can also takes place by using this EPS, that is earnings per share. Next one is accounting standard 21, preparation and presentation of consolidated financial statement. So, all the applications relating to the presentation as well as preparation of consolidated financial statement comes under accounting standard 21. So, what are the rules to be followed? So, how it has been applied? So, what are the guidelines to be followed? Everything comes under accounting standard 21. Next is accounting standard 22. So, it is related to the taxes on income, accounting for taxes on income. The objective of this standard to prescribe the accounting treatment of taxes on income, since the taxable income may be significantly different from the income displayed in the financial statement due to many reasons. So, whatever the amount which is shown in the financial statement, so we cannot tell that whole amount is taxable. So, what is the amount that is been taxable? So, that will be included in the accounting standard 22. Next is accounting standard 23. So, it's relating to the accounting for investments on associates. So, what are the investments which are made on associates? So, that comes under accounting standard 23. So, this standard should be applied in accounting for investment in associates in preparation and presentation of the consolidated financial statement by an investor. So, by preparing the consolidated financial statement, so the transactions relating to the investments in associates, so that comes under accounting standard 23. Next is accounting standard 24. So, this is discontinuing operation, or the transactions relating to discontinuing operations are included in the accounting standard 24. Next is accounting standard 25. So, we are come across interim financial reporting. So, what do you mean by interim? On a short duration, we are going to report the financial statements. So, that all comes under accounting standard 25. So, this standard applies if an entity is required or elects to publish the interim financial report. So, instead of presenting the financial report at the end of the financial year, so based on the demand, so here the financial statement can be prepared for every 3 months or for every 6 months. So those comes under accounting standard 25. The prime objective of this standard is to prescribe the minimum content of an interim financial report. So in order to make the interim financial report too short, this accounting standard 25 is being used. So this standard also prescribes the principles for the recognition and measurement of financial statement for the interim period. So this helps in preparing the financial statement for a shorter period, that is interim period. Next is accounting standard 26. So it's all related to the intangible assets. The transactions or the applications of accounting relating to intangible assets are included in the accounting standard 26. Next is joint venture. Accounting standard 27 is related to the joint venture reporting of interest in the financial statement. So, in the joint venture also they have to prepare the proper financial statement. So, how they are going to prepare? So, that we learn under accounting standard 27, where we are completely going to learn about the joint ventures. Next, accounting standard 28. So, it is relating to the impairment of assets. Now, what is this impairment of assets? The objective of Accounting Standard 28 is to prescribe the procedure that an enterprise applies to ensure that its assets are carried at no more than their recoverable amount. So, here the assets cannot be carried on their recoverable amount. Impairment of assets are included in Accounting Standard 28. The assets can be reported as impaired if its carrying amount exceeds the amount to the recovered through the use or sale of the asset. So, if the value is more than the actual amount, so they all comes under impairment of assets, that is Accounting Standard 28. Next is contingent liabilities and contingent assets and provisions. We are going to learn under Accounting Standard 29. Just we have to know on which standard what we are going to learn. So, this contingent liability and contingent assets and provisions we are going to learn under Accounting Standard 29. So, these are the few list of mandatory accounting standards. Now, coming to accounting standard list which are non-mandatory in nature. So, here ICAI, that is Institute of Chartered Accountant of India, announced withdrawing the following accounting standards. So, they have withdrawn certain accounting standards like Accounting Standard 30, which was based on financial instruments, recognition and measurement, and Accounting Standard 31, that is financial instruments presentation, and Accounting Standard 32, financial instruments disclosure. So, they have withdrawn these accounting standards which have considered as it is not mandatory. Now, let us see what is the difference between IFRS and Indian accounting standards. So, IFRS stands for International Financial Reporting Standard. So, let us see what is the difference between these two. IFRS stands for International Financial Reporting Standard. So, it is prepared by IASB, that is International Accounting Standard Board. So, here International Accounting Standard Board prepared this IFRS, that is International Financial Reporting Standard. So, it is used in 144 countries and is regarded as one of the most popular accounting standard. So, when compared to Indian accounting standard, so Indian accounting standard is confined only to India, whereas this IFRS, International Financial Reporting Standard, so it includes or it is used in 144 countries and it is regarded as one of the most popular accounting standard. So, Indian accounting standard is also known as, or INDAS is also known as Indian accounting standard or Indian version of IFRS. So, it is an Indian version of IFRS because it is only confined to India. So, Indian accounting standard or INDAS, that is Indian accounting standard, is used in the context of Indian companies. So, based on the Indian company, this Indian accounting standard is being framed. So, this is the introduction about IFRS and Indian accounting standard. Now, coming to the difference between these two. So, let us see what are the main difference here. So, as we all know, as the name itself suggests that IFRS is used all over the world, but whereas Indian accounting standard is used only in India. So, if you see the definition here, IFRS stands for International Financial Reporting Standard. It is an internationally recognized accounting standard. So, it is being used internationally. It is not only confined to a particular country, it is being used internationally. Whereas Indian accounting standard, INDAS stands for Indian Accounting Standard. It is also known as Indian specific version of IFRS. So, it is a specific version of IFRS where it is only confined to India. Next one is developed by. So, who have developed or who has developed IFRS? IASB, that is International Accounting Standard Board. Whereas Indian Accounting Standard is developed by whom? MCA, that is Ministry of Corporate Affairs. So, this is a main difference here based on the development. Next, followed by. So, who is going to follow this IFRS? 144 countries across the world. So, it is a international financial reporting standard where it is being followed or it is being used by 144 countries. Whereas Indian accounting standard is used only or it is being followed only by India. Next one is disclosure. Companies complying with IFRS have to disclose as a note that the financial statement comply with IFRS. So whenever they use this IFRS and prepare the financial statement, they have to disclose that they have used this IFRS. Whereas Indian accounting standard, such a disclosure is not mandatory. So such type of disclosure, that is, they disclosing that they have used the Indian accounting standard and prepare the financial statement. So such type of disclosure is not necessary here for companies complying with Indian accounting standard or INDAS. So here it is not compulsory, but here it is in IFRS, it is mandatory that each and every company who is going to follow the IFRS, they have to disclose. Next one is financial statement components. So let us see what are the financial statement components that are included in IFRS and Indian accounting standard. So it includes the following. So this IFRS includes statements of financial position, statement of profit or loss, statement of changes in equity for the period, statement of cash flow for the period. So these are all included in IFRS. Whereas coming to Indian accounting standard, it includes balance sheet, profit and loss account, cash flow statement, statement of changes in equity, notes to financial statement, disclosure of accounting policy. So all these are included in the Indian accounting standard. Next one is balance sheet format. So companies complying with IFRS need have a specific guidelines for preparing the balance sheet with assets and liability to the classified as current as well as non-current. So here a proper classification has to be made while they are going to prepare the financial statement, that is balance sheet, a list of assets with current as well as non-current asset and a list of liability with current as well as non-current liability has to be included. Whereas coming to Indian accounting standard, companies complying with INDAS need not have such requirements. So there is no such requirements for balance sheet format, but the guidelines are defined for presenting the balance sheet. So here the guidelines will be given, but they need not strictly follow this requirement. There is no such requirements in the Indian accounting standard. So these are the main difference between IFRS as well as Indian accounting standard. Hope you have understood what are the main difference here. So we have learned lot of difference between Indian accounting standard as well as IFRS. So my dear students, hope you have understood today's session. See you all in my next session with a new topic. Till then, take care. Thank you.